to Investors Guide. Thank you for tuning in. We have a brand new show lined up for you today. We're going to look at various things like how do you switch from your regular plan to a direct plan if you want to, and what are the tax implications. But let's take a look at what we have lined up for you in the next half hour. We'll look at our income growth portfolio for our retired viewers. We'll take a look at the Reliance Mid and Small Cap Fund. Should you still remain invested? And how can you diversify your portfolio? All of that is coming up later on the show. Right now, I'm going to invite Dhirendra Kumar to the show. Dhirendra, thank you so much for joining us. It's a pleasure to have you on the show, as always.
Thank you.
We want to do a quick review of our income growth portfolio because we've got some viewers who are interested in it. I understand you want to make a change. So, but as it stands right now, there's the FT India Dynamic P Ratio Fund of Funds, HDFC MIP, Reliance MIP, and UTI Balanced. You want to make one change in this portfolio, from what I understand, and switch it out for Tata Balanced. Tell us why you're making that change at this point.
I was not tempted to make too many changes unnecessarily. So the only change that has been made so far this time is replacing the balanced UTI balance with a superior balance fund, and that to a conservative balance fund, a balance fund which does not lose its balance despite the the greater tilt. Balance funds have 65% allocation to equity, so we are targeting that allocation, but targeting it with a conservative equity allocation, because that is the idea of this portfolio. Somebody deriving income from his portfolio in a manner that he's able to beat inflation and keeping his withdrawal at a reasonable rate. I wanted to make some more change, but I resisted that because that would have changed the asset allocation in a manner that will change the risk profile of the fund. We have two MIPs, conservative MIPs, which are about 30% into equity. We have one balance fund, which is about 65% equally in four funds, and the dynamic P ratio fund, which changes its allocation depending on the market. And both, all the four funds were able to deliver about 10 and a quarter. So in fact, we have had a very low payoff from the balance fund. And so that's the whole idea, enhance the return there. The other thing I was exploring, that how to make this portfolio more tax efficient, because this portfolio is not as tax efficient as our other portfolios, because the return derived from 3 of the 4 funds is not tax free. 2 of them are fixed income oriented fund with little equity allocation, and dynamic P ratio fund, because the allocation changes and it does not charge STT, so you can well be it on many occasions it is a fixed income fund. It can well be a fixed income fund, so it is not it is not treated as an equity fund. Fortunately, this portfolio is now old, so holding of over 3 years and the kind of gain that we have witnessed, of course, it translates into superior tax efficiency, because the capital gains is not there. After indexation, it doesn't matter. Your tax incidence gets reduced substantially. So I was trying to minimize the tax incidence, and that we're looking at to make it, substituting the 2 MIPs, but I haven't been able to, come up with any superior alternatives, so the status quo.
Well, Dhirendra, for anyone who's going to use this portfolio now, obviously targeted at a retired person who has a regular income coming in, what is your word of advice when actually using this portfolio? What should they keep in mind, and what should be the goal of this portfolio?
The goal of this portfolio is very straightforward. In fact, all our other portfolios, one can still be a little ambiguous about what is growth and what is aggressive growth or what is stable growth. But this is very precise. You put your lump sum and derive periodic income in a manner, and the investment is made in a manner that you should be able to, your capital doesn't lose its value, and that is what we have witnessed so far. In the 7 years since its start, we have derived about 8% annual return on the capital invested. The investment was made lump sum, and it has translated into a return of about 10% on the aggregate portfolio, little over 10% on the aggregate portfolio. 8% of that 10% return has been realized periodically every quarter. And so my sense is that one should look at it exactly like that. One should only have this expectation. If you are not withdrawing periodically, this can, I don't think you should look at it as an accumulative portfolio, or one should not look at it as a way to invest your lump sum. It should only be looked upon as a portfolio to derive income from. And my sense is that, we have taken a very aggressive withdrawal rate here, 8%, and we have still been able to protect the capital, but that may not be the case in future. So one should be a little more conservative. I think just look at it like this. If you invest lump sum, today if you make a deposit, you'll be very lucky to get a return of 10%. And if you are in the highest tax bracket, your effective post-tax return will be 7%. So keep your withdrawal rate to 7%, and because that is a comparable post-tax rate, and increase your withdrawal rate, periodically, 1 year or every 2 years, revise it depending on the state of your capital.
Right, so it's very simple. You need to have, of course, regular money coming in. This is your substitute for that regular money. The rate is saying that you can pull out about 7% to begin with, and then over a period of time, as the corpus grows, because of the equity allocation we have from the balance fund and from the 2 MIPs, then you can increase the withdrawals that you take out of this particular portfolio. Devendra, let's answer a question that's come in on our financial plan this week. Our profile is of a 33-year-old with 2 dependents who wants to plan for his children's future and for his own retirement. Abhishek Yadav has written in. Now, he sent us a list of short-term and long-term goals, very carefully actually segregated. He tells us short-term goals in the first 3 years. He'd like to completely pay off his 31 lakh rupee outstanding on his home loan and take a vacation overseas for 5 lakh rupees. Now, in 5 years, he wants to put down a down payment for a second home and buy a car worth 25 lakh rupees. And in 18 and 20 years, he wants to put aside money for his children's education and for their weddings and for his own retirement. Now, he currently has about 2.4 lakh rupees coming in income every month. He has savings, he's got his home loan, he's got term life insurance, he's got health insurance. Everything seems fairly carefully planned, except his mutual funds, because he only has 2 mutual funds right now. 5,000 rupees going into the SBI Blue Chip and 3,000 into L&T India Prudence Fund. Now, if he's going to have these ambitious goals, he's going to need more than just these 2 funds, isn't he?
Yeah, absolutely. And, prepaying the home loan very quickly, I don't understand the whole rationale for it. There must be some, if there is any reason to it, he should think about it. This is a long-term, borrowing. This is a long-term debt. And you are incurring a cost which you have to really consider that why you need to prepay. A large sum of money has to go towards this. Where will you derive this capital? Which means all your investment plan will be shelved for a while. He needs to, just earning is not enough, saving is not enough. Investing well, carefully, in a disciplined manner is just as important. And earmarking your goals is important. That is what we earn for. And that is why your money should also grow more, more methodically, or it should be planned for. But planning your, grow goals is just one side of it. If you don't really, if you're not disciplined about your periodic contribution towards those goals, and understand the basics of, what is the most appropriate way to achieve that. So think about all your prepayment. Take a holistic look at your whole, your inflows and your goals, and you are very nicely placed. Your scale of income and your savings. If you just postpone your, if you actually defer your idea of, prepaying your home loan, then most other things are likely to fall in place.
Devendra, if we look at just his mutual funds right now, I'm not extremely pleased with the fact that he has only 2 funds, and they're also not extremely well selected for the goals he has in mind, because he has the SBI Blue Chip Fund and the L&T India Prudence Fund, and he has goals that are 18 and 20 years away that are quite aggressive. Which one of our portfolios would he be better off using?
I would like to suggest him a simpler plan. One is that he should choose a fixed income fund, a short-term bond fund, or even a dynamic bond fund for his goals in next 3 to 5 years. His need for vacation, and that is that is equivalent of a recurring deposit. I don't think he should get very and a small amount of money can well achieve his 5 lakh needed in the next 3-4 years, things like that. That apart, I think all his long-term goals, the goals within next 10 years, he should look at our growth portfolio. Goals beyond 10 years and more should be our aggressive growth portfolio, and he should just be very methodical and disciplined about it. Do a review every 3 years, maybe watch our program once again for an update on that, and that's all that is needed.
There is just one question. The second goal that he has of wanting to buy a second car in about 5 years' time for 25 lakh rupees. And he wants to also put a down payment down on a second home. Now, would he be better off if this is 5 years away or 6 years away using a balanced fund rather than just a bond fund for 5 years or 6 years, because we know that the prices of cars move quite quickly. And this is not something that's worth 25 lakh rupees is not going to be worth 25 lakh rupees in 5 years' time. So would he be better off using something slightly more aggressive?
Yes, ideally. And, but it depends on the person. These are negotiable goals. If you have to go for your holiday in next 5 years, and if you have been able to accumulate more money or enough money in the next 3 years itself, might as well prepone your holiday. Likewise, a balanced fund can help you buy your holiday as well as, buy the car bit earlier. But I would still say that, because he has a sizable saving going into it, it's very important for him to develop a belief in the whole method. These are negotiable goals, and he can, if I want a good part of it to be in fixed income, because till he is actually availing these negotiable goals, that will also act as an emergency fund. And his long-term goals, that should be non-negotiable. He should drop a plan and stick to it. And that is the only way he'll be able to achieve his goals. These are fairly aggressive goals, his long-term goals. And one more important thing which he should keep in mind is increasing his investments with rising income over time.
Right, increase your investments with rising income. So here's the advice you're getting right now. Just make sure that you don't prepay your home loan. Continue to pay the EMIs on your home loan. It gives you a tax benefit, and it's a very useful loan to have. Other than that, use a bond fund for anything that's 3 years away or closer, because that's a good way to approach that goal. And for your investments that are 18 years away or 20 years away, for those goals, use our growth portfolio that's on your screen right now and our aggressive growth portfolio, which we will email to you. Today, we have a very interesting question that's coming from Vaibhav. Now, Vaibhav has been investing in the regular plans of mutual funds for a while, and it's accumulated to a lump sum. He now wants to switch to the direct plan of the same mutual fund. He says, does it make sense to withdraw the money and then invest a lump sum in a direct plan? Because net, what sort of risk is he taking? Also, he's invested in the Birla Sun Life Frontline Equity and iProve Discovery. Although he stopped his SIPs, he now wants to build a new portfolio with the direct plans of the same funds. So here's the question. If someone is in a regular fund and they want to move to a direct plan, what's the best way to make that change?
Two things to keep in mind. One is the exit load and the other is the short-term capital gains. All your investments made in equity funds in the past 1 year will be liable for these two. Typically, every equity fund levies a exit load of 1% or more, sometimes more, for redemption within 1 year. So just be aware of that. And so all your accumulation, all the SIP, installments, which are more than 1 year old, you can safely withdraw and move that money to a regular plan. And this is also a time to review your portfolio, because you are making this redemption and investments once again. So if any change to be made, this also presents an opportune time.
Given the fact that he's already invested in that fund and he's moving from the regular to the direct plan, there's no risk there of making a lump sum investment, because it's actually just shifting from one bucket to another bucket. So I think his concern here is, because we keep saying on the show not to make lump sum investments, in this sort of a move, it doesn't really affect him, does it?
No, I think you can safely move your money and just forget about it. You'll be earning 1% more by moving this, and don't even think that you are moving your money. The real problem is that most people get anchored to a value which you will realize. The moment you have made your 10,000 rupee SIP investment over the last 5 years, and that has translated into 10 lakh rupees. And the moment you make this 10 lakh rupees investment, it goes down by even 50,000. You will start regretting. So if you are able to, and this is a bias, this is a, behavioral, getting anchored to a value in our mind and feeling sorry about it. And that causes anxiety. So if you are able to forget this interim technical event that is going to enhance your return, and if you are able to, relate to this lump sum investment, don't recall the lump sum investment that you are going to make. That is the only problem that you have to overcome. Otherwise, I don't think there is any issue, because you are invested in the same fund. You will be invested in the same fund, which will be incurring less cost, and that is all that is going to happen to your money.
All right, quick takeaways before we go into break. if you have a home loan, and I know as Indians we have a tendency to want to pay off our loans as quickly as possible, but the home loan is the best loan to hold on to. Pay off your credit card instead, or pay off any other personal loan that you might have, but hold on to your home loan. Don't be in such a hurry to pay it off. Invest aggressively in equity for your long-term goals. And Dhirendra is saying that if you have a fund right now that's in the regular option, you want to switch it to a direct option, then just go ahead and do so. Don't be worried about making that lump sum investment, provided you've crossed the 1-year mark, so you don't have to pay tax. In our product review this week, we're looking at the Reliance Mid and Small Cap Fund.
Thanks, Faye. This week, we take a look at Reliance Mid and Small Cap Fund. Now, the fund that was earlier called Reliance Long-Term Equity has had a name change to Reliance Mid and Small Cap in the year 2015. With just about 2 stars on value research, let's take a look at the fund's performance in the last 5 years. The red line is the fund and the blue line its benchmark. You'll see that the fund's performance has been average, barely outperforming its benchmark and category in the last 5 years. In the year 2015, however, the fund underperformed its category with a return of just 8%. The fund's performance has not been impressive in the last 1 year, especially giving a return of 16%. In fact, you'll also see that the fund's returns have been particularly disappointing when compared to its peers in a rising market. The fund's long-term performance does not stack up well either. Is this a fund that you should let go of? Let's find out. With that, it's back to you, Faye.
The fund changed its name in January last year, and it's down to 2 stars. From where it used to be. And this is normally something that causes a lot of investors a fair amount of nervousness when the star rating falls this low. What is your recommendation on this fund? Would you recommend investors hold on to it anymore, or is it time to cut our losses?
No, actually there was a change in objective. It was, go anywhere fund, which had got defined in January since January 2015. It changed its objective. Now it will be a mid and small cap fund from here on. Earlier it was possible to, it was trying to earlier it was called long-term opportunity fund, and it was trying to take, capitalize on special situations or, potentially, companies with potential over the long run. And so earlier the mandate was more flexible. Now it has got more finely defined. And, despite the fund company's strength in this segment, look at the small cap fund or look at the tax saving fund, which derives most of its, great performance from small caps, this fund has not been impressive. It's a big fund. It was a big fund to begin with, and not much has changed. It remains a fairly mediocre fund. It's not very volatile and delivers a below average return in its category. I think it can also be attributed to, other funds doing exceptionally well. You can have very disappointing fund in this category and absolutely outstanding fund in this category, and that is the charm of this category. And this fund doesn't stack up.
This fund doesn't stack up. It's not the ideal choice right now. Dhirendra, for those investors who are pulling their money out of this fund at this point, where would you rather have them invest their money?
If any investor is happy with this fund, I think this is the kind of fund, this is the kind of return which should be derived from a balanced fund or even a lower equity allocation. And you have a set of, mid and small cap fund in the aggressive portfolio or the growth portfolio, which will be far superior. But don't bank on those, some of them. If you have to look at these alternative small cap fund, the choice is, if I have to pick 1 or 2, I would go with, Franklin's Smaller Companies Fund or DST BlackRock Micro Cap, and even Reliance Small Cap might be a superior bet.
Reliance Small Cap, those funds are on your screen right now. If you need any help, of course, with those investments, you can get back to us. Dhirendra, finally, your star rating of this fund, it's 2 stars on value research. Where would you place it for the Investors Guide viewers?
Even there, I would place it at 2 stars because this fund is disappointing relative to others. But in absolute terms, it is not a fund which has left investors high and dry.
All right. If you have any more questions about that fund, you can get in touch with us. Our email ID is at the bottom of your screen. It's time to move on to our segment called Buy a Home. Dhirendra, you'll find this question very interesting. 31-year-old Ravi Sharma has written in. He makes 1 lakh rupees a month. He has 3 dependents. He has some money going into the PPF on a yearly basis. It's a proper 1 crore rupee term cover, and he just started investing in mutual funds. He wants to achieve, he says, financial freedom by the age of 50, and he wants to know how he can invest his investment profile. But The interesting question, and the reason why we picked it up, is because he's asked this question. He says everybody's asking him to buy a home, but to him it seems more like a burden than an asset. Should he go ahead and buy a home? From a 31-year-old, just proving to us that younger India right now is thinking in a completely different manner from everyone else in the previous generation. This is a generation that doesn't mind borrowing and doesn't want to be tied down. So he's looking at the option of buying a home as a burden and something that will chain him to his desk, I assume, someone who enjoys financial freedom. What advice would you give him?
I think, at a certain level, buying a house is more than an economic exercise. But somebody looking at it very objectively, it's very interesting to find that. And I agree with him at a different level, that going by the capital value of homes in most leading large cities in this country, it is unviable. It just doesn't make economic sense. The kind of rent that you pay for an asset is far lower than the interest that you'll incur. But one has to look at it little beyond that. But at the same time, you need to buy a house, and it provides you many other things which is otherwise not available in investment, and it definitely provides you the emotional comfort of owning a house which will turn out to be useful in the worst of times. And with that, but that apart, don't. I would say that most individuals thinking like this should find 3 rules to follow, which will come in handy. One is that don't stretch beyond a point. Don't ensure that you have the down payment. Make sure that you are not going to pay more than a third of your income, your current income, to repay the loan. And third is that make sure that you're going to live in that house, because if you're buying an asset and incurring the interest and repaying the loan, and the rental yield will be so substantial, will be so low. And I'm not very optimistic about even the long-term potential gains on the capital values going by your capital values today.
Well, of course, buying a home is a very emotional decision, and there's a lot more to that than pure finances. But if you feel right now that you're not ready to buy a home, you shouldn't succumb to pressure from either your family or from anybody else to go ahead and make that commitment, because it's a huge commitment of a 20-year or a 15-year loan that you're going to pay off. So make sure that you're ready. Consider it apples and oranges. If you were going to consider it to compare it to any other investment, then consider all of the expenses that will go out. There's property tax, there's maintenance, there's a lot of other things that you have to consider when you're buying a home vis-a-vis equity or a mutual fund where the costs are far lower. But again, most Indian families and most Indians prefer to have a home that they live in, that is theirs. So keep that in mind. This is the advice that we got in this particular part of the show. Don't stretch your money or finances or your comfort level to buy a home. Wait until you're completely ready. And do not pay more than a third of your current income or your take-home income for your loans. Also, as always, the advice is to stay away from sectoral or thematic funds. If you're investing in mutual funds, the idea is to not restrict yourself. Teresa, thank you so much for joining us on the show and answering all of our questions. Thank you for watching at home. Remember, we're here to help you if you need anything at all to do with your money. Thanks for watching.